Days after the Silicon Valley Bank crisis, the Federal Reserve raised interest rate for the ninth time. Now this time around, Fed increased the benchmark interest rate, which is used for everything from setting mortgage rates and loans to credit cards, by about 25 basis points. Now this increased the rate to a range of 4.75% to 5%, which is the highest since September 2007. The Central Bank of the US is still responding to inflation in the US that remains about 2% of the Fed's inflation target. It has now dropped to 6% in February since hitting a peak of 9.1% in June. Now, are you wondering if the Fed will raise interest rates again with inflation easing and amid the ongoing mini banking crisis in America? So let's look at what the Fed chair had to say in the recent FOMC meeting.
We were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, some policy firming may be appropriate.
So Powell had indicated that the central bank may have to take more aggressive path to tame inflation in the previous meetings. However, a fast-moving banking crisis has cautioned the Fed. At first, the US markets were pleased with the shift in wording from continual interest rate hikes to perhaps a few more hikes depending on new information. However, this positivity didn't last long. Ultimately, it appears that inflation in the US remains too high, above the 2% target, and that further interest rate increases might be necessary. We are all aware of high inflation, rising interest rates, and the gloomy global economic outlook. But have you wondered what that means for companies, especially for companies that are looking to go public? Well, among other things, it makes it difficult for them to raise money. That's why 2022 has not been a good year for IPOs. On the back of this higher market volatility, the initial public offering market has also remained subdued in 2023, with many companies postponing their issues or even withdrawing it. In fact, the month of February 2023 did not see any public issues. Also, since November of 2022, newly listed companies have displayed poor performance in the recent months. As we can see from the chart, apart from 2 IPOs, 9 other companies are currently trading at a discount of up to 40% compared to their IPO price. So what are the factors contributing to the poor performance of IPOs? Now, do know that market sentiment plays a significant role in public offerings during volatility. Now, primary market sentiment is connected to secondary market activity and trends. Indian stock markets have witnessed volatility due to several factors such as high interest rates, global recessionary fears, the Adani crisis, and the recent global banking crisis. On the back of this, Sensex and Nifty benchmarks have declined by around 6% to a year-to-date basis. Now, another reason is, in addition to the market volatility, is the poor performance of new age startups that went public, such as Zomato, Paytm, and Nykaa. Now, this has made investors more cautious about investing in new offerings, given that the majority of them are trading at a discount. So what does this news mean for you? The Fed has raised interest rate hikes yet again, but this time the pace of interest rate hike eased after signs that inflation may be slowing. This will have an indirect neutral impact on you. Amid this market turbulence, only companies that are attractively priced and deemed good by investors are likely to receive a positive response. Also, as an investor, it is important to focus on the fundamentals of a company and do your own due diligence and not follow unreliable IPO trends. This will have an indirect neutral impact on you. While I say this is me, Merlin Susanna signing off. Take care and stay invested.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.